Guys, welcome to another week of State of the Market. As you all know, I am Marc Fattore, joined by the lovely co-host Jennifer Dolh. And in this week's State of the Market, we actually touch on a little bit about build to rent. So I'll let Jennifer take the stage now and ask away.
3 questions as always. Number 1 for this week, we have received this question actually, it's been a popular one. We have seen a strong rebound in rental yields in both houses and apartments over the last few months, with a significant jump in apartment growth across the nation in most capital cities. Are we starting to see a new cycle in apartments making a comeback as an investment?
Awesome question. Short answer, I think yes, we are. I don't think we ever saw them maybe take too much of a dip, depending on obviously what you look at from an investment point of view, that is. But I think more importantly, what we need to look at is obviously what our cash on cash return is. So right now we are starting to see that there are some really good opportunities where, yeah, there's strata costs and things like that, but what we're getting as a cash on cash return far outweighs what our overheads are from an apartment investment point of view. Now, not saying that they're for everyone, of course, and in some parts of the country they don't grow as well as what they do in others, but regardless, depending on your strategy, apartments can certainly be a very good little addition to your portfolio now, yeah.
I agree. It's actually very popular at the moment, but that's okay. That was a good answer actually. Build to rent has been popular choice for some superfunds as well as the fund management firms across the country in the last 2 years. Something we have seen being quite popular with familiar firms and similar firms actually in the US. Is there a reason behind this, and why are we seeing more of it here in Australia now?
Yeah, again, Jen, another good question. And I think it's pretty straightforward. What people are starting to do now is hedge their money, obviously against getting a good return. So what we're seeing is from these larger type of corporations is we are starting to put in, obviously, or they are starting to put in a lot more effort towards getting that cash on cash return. Valuations are one thing, and I think we discussed this last week as well. But more importantly, what we're starting to see is, the sale of a development site, as an example. Yes, it still gets, a good return, and we're very liquid in that regard, but people are wanting that long-term return. People are living longer, things like that. So as a developer, usually what we see as a cycle, and it has happened in the US quite often, that's why we are starting to see it here, is that the usual process would be to acquire a site, develop, sell off, repeat the process. Now what they're starting to do, or what we're starting to see a lot more these days, is a lot of, let's say, debt coverage. So cover the construction costs and then obviously hold on to the rest. So they might only sell off maybe a very small portion of the development and then continue to hold the rest, because that'll be consistent revenue for however long they may want it to have. And obviously then on selling that, let's say that residual stock, we like to call it, can be sold at a much higher price as well, because obviously a yield starts to be developed from it. So interesting times ahead with the build to rent sector, yeah.
Awesome. I actually had this client ask me this question over the weekend. So co-living investments seem to be providing a huge cash on return to investors that put money into them in the last 24 or 12 months even across the country. Are these a great addition to add to your investment portfolio?
Yeah, they are. Again, short answer, they are. One thing I am mindful of, and it's only because I have been in the finance world back a while back, was in the process of financing these type of development opportunities or investment opportunities. Now, one thing that banks do look at is how that, let's say that house would rent out if it was only occupied by one tenant. So you might be getting, let's say, $1,000 per week on having 5 rooms, and they're $200 each, let's call it. But they'll assume that, okay, X amount of rooms, if a family was living in there, it might only rent for $500-$600 a week. So the yields are great. You just got to be cautious of that, and of course find the right banks that do accept it for what it is. But at the same time, yeah, short answer, great investment to the portfolio.
Fantastic. That's it for today actually. Guys, the gist now actually on how the questions work. Your questions will remain anonymous anyway. So if you want to shoot Marc or myself, a DM on LinkedIn or comment below, we'll have these answered for you guys next week. But that's all for today. I hope you enjoy a lovely week. Take care.
See you guys.